Welcome to the deep dive. We're here to cut through that noise and get you straight to the insights. And you've probably noticed, the S&P 500, it's been on this incredible run, right? Up roughly 30% since, what, early April?
Yeah, it's quite something.
It even set a fresh all-time high back on June 27th, wiped out that whole painful 18.9% spring swoon we lived through.
Absolutely erased it.
But let's be real. You look around, listen to the pundits, and the feeling is pretty skeptical, wouldn't you say? Like, can this rally possibly keep going?
That skepticism is definitely out there. And look, it's understandable. But that's exactly where we want to maybe challenge things a bit today.
Okay.
Because, while everyone's focused on the now and the immediate headlines, history often tells a very different story, sometimes a surprising one.
Right.
So today we're diving into some really fascinating analysis. It's from Alec Young over at moneyflows.com. And he's found these three distinct historical, let's call them momentum signal studies.
Momentum signals, okay.
Yeah, and when you put them together, they seem to strongly point towards, well, potentially big upside still ahead for the market.
Okay, so let's unpack that then. Our mission today is basically to dig into these historical patterns, see what they really suggest for where the market might be headed, and hopefully help you get a more informed view on that, well, that million-dollar question.
Yeah.
Does this rally have more gas in the tank?
Exactly.
So let's kick things off with something super relevant right now. We just saw the market climb out of that correction.
Right.
What does history tell us happens after stocks pull themselves out of a dip like that?
Yeah, it's a really key question given where we are. So this first study, it looked at all 23 S&P 500 corrections.
23 of them.
Yeah, and just to be clear, a correction means a drop between 10% and 20%. Not quite a bear market, but, significant.
Got it.
And this goes all the way back to 1950. So a lot of data. Main thing they looked at was stock performance 6 months and then 12 months after the S&P 500 got all these losses back.
Ah, okay. So once it clawed its way back to even, what tended to happen next?
Yeah.
And what did that deep dive show? I'm guessing maybe not what the nervous Nellies might expect.
Hey, you're right. The results were, well, surprisingly upbeat, almost counterintuitive if you're feeling anxious after a dip.
Yeah.
On average, the S&P 500 gained 8.8% after 6 months.
8.8%. Okay.
And get this, 16.5% after 12 months.
16.5% a year later. Wow.
Yeah, and both of those numbers are, like, well above the long-term averages for any typical 6 or 12-month stretch.
Those are strong averages, but, averages can hide things. How consistent was that? Was it just a few massive rallies pulling up the average, or?
That's what's really striking, actually, the consistency. Stocks were positive more than 90% of the time.
90%.
Both 6 months out and 12 months out after that full recovery was made. So it's not just an average skewed by outliers. It's a highly reliable pattern over decades.
Okay, so bringing that back to today.
Yeah.
The S&P is currently only up, about 2.5% since it got back everything it lost in the spring.
That's right, just a couple of percent.
So if this historical pattern holds any water, what does that suggest? It sounds like maybe there's quite a bit more room to run based on history.
That's certainly what the historical precedent would imply, yes.
Okay, that's encouraging for the post-correction phase. But let's zoom out a bit and think about the whole life cycle of a bull market. How does our current one, the one we're in right now, compare to the grand sweep of history? Are we, getting old, long in the tooth, or still relatively young?
Good question. And that brings us to the second study. This one provides that broader perspective. It looked at 19 S&P 500 bull markets going all the way back to 1938.
Okay, 19 bull markets since 38. That gives us a solid benchmark.
Really solid benchmark, yeah.
And what are those benchmarks? What's the typical run? How long does an average bull market last? And how much does it typically gain?
Well, the historical averages are pretty revealing. The average bull market advances 133%.
133%.
Yeah, a big number. And it lasts, on average, just under 4 years, specifically about 3.8 years.
Okay, 133% gain over almost 4 years. That's the historical yardstick.
High yardstick.
So our current bull market started, let's see, October 2022. How does it stack up against those numbers?
Right. Well, this is where it gets really interesting for today's situation. Our current bull market, it's only up about 80%.
Only 80% compared to 133 average.
Exactly. And duration-wise, it's been running for just 2.8 years so far.
Compared to the average of 3.8 years.
Right. So if you put that together, I mean, history here strongly suggests this current rally could still have significant further upside.
Uh-huh.
And potentially, maybe another year left to run before it even hits those average historical marks.
So by historical standards, it's not actually old yet.
Not really, no. It suggests it could still be in its middle innings, so to speak.
Digging deeper, the analysis didn't just stop at averages. It looked at performance within bull markets, like year by year.
That's right.
And there's apparently a really intriguing pattern that shows up later on.
Exactly. This third study zeroed in specifically on the performance of bull markets once they get into their fourth year, looking for, any distinct trends in that more mature phase.
And what's the deal with year 4? Does the market start to tire out, slow down, or does something else happen?
It's pretty much the opposite of slowing down. The fourth year of a bull market, on average, has delivered a very healthy market-beating gain of 14.6%.
14.6% in the fourth year.
Yes. It's almost like the market hits a second wind, maybe as the earlier skepticism finally fades and earnings really catch up.
Wow, 14.6% average gain.
Yeah.
That's not trivial, is it? Especially, you mentioned comparing it to how the third year usually performs.
Right. That's the key context. This 14.6% average is a huge acceleration from the average performance seen in the third year of these bull markets, which is only about 2.2%.
Only 2.2% in year 3, then jumps to 14.6% average in year 4. That's remarkable.
It really highlights this historical tendency for late-stage strength in bull markets.
Okay, so connecting the dots again, the current bull market's 4th birthday is coming up, right? October 12th.
That's right. Just around the corner.
So if that historical pattern of acceleration holds, what might that suggest for the market, say, through the rest of this year?
Well, it certainly raises an interesting possibility for you to think about, doesn't it? If history's any guide, it suggests the market could actually see a stronger push in the coming months rather than, hitting some kind of wall.
Instead of fading, it accelerates.
Potentially. And what's really powerful here, I think, is when you take all three studies together.
Right.
You've got the post-correction recovery pattern, the average bull market lifespan and gains, and this fourth-year acceleration. You end up with three, pretty bankable historical analogs, all kind of pointing in the same direction. Further gains ahead.
3 distinct historical threads weaving the same story. Okay, so we've laid out these, frankly, quite compelling historical arguments suggesting more upside. But let's pivot now. What does this actually mean for your portfolio? How do we translate this history lesson into, practical thoughts for today?
Right, the so what question. This is where the idea of momentum becomes really critical. The analysis strongly emphasizes this. History suggests, and we're seeing it now, that strength often begets more strength. Momentum, this tendency for things that are going up to keep going up, tends to persist.
Okay, momentum. And it's not just a theoretical concept, right? The data is backing this up strongly, right?
Oh, absolutely. Dramatically even. Momentum has been by far the best performing investment factor year to date.
By far.
Yeah. Get this. Momentum strategies were up about 19% in the first half of the year.
19%.
Compare that to the S&P 500 itself, which is up, 6.2%?
Wow, that's a massive difference. Triple the performance, almost.
Huge divergence. And no other investment factor like value or growth or quality was even close to that 19% momentum figure.
Okay, so momentum is clearly leading the pack. Which areas, which sectors are really embodying that strength right now? Where are these momentum strategies pointing?
Well, the analysis highlights the top-ranked sectors that are really driving this. It's areas like industrials, technology, and financials.
Industrials, tech, financials.
Okay. Yeah, these have been the big winners in 2025, and they're featuring heavily in these momentum approaches. That's where the momentum is most obvious.
So, given that strength, what's the recommended strategy? Is it just, jump on the fastest moving train, or is there more nuance?
It's a bit more nuanced. The source actually suggests that healthy profit-taking, the occasional pullback, even in strong stocks, that actually creates buyable dips.
Ah, so use the dips within the trend.
Exactly. It's not necessarily about chasing the absolute highs every day, but recognizing the persistence of the trend and using those inevitable short-term pullbacks as opportunities to potentially get in or add at better prices.
Makes sense. Strategic entry within the larger trend.
Precisely. It's a way to try and capitalize on that expected continued strength.
So putting it all together, what's the overall outlook here? Are we talking about momentum just being a short-term thing, or does it have a longer runway based on everything we've discussed, the history, the current performance?
The expectation based on this analysis and the historical patterns, is that momentum stocks are likely to continue leading the market higher, probably through the end of the year.
Through year end.
Yeah. High-quality momentum names, the ones with strong earnings supporting the price action, they're seen as some of the potentially best bets right now. The feeling is they have, plenty of gas left in the tank to potentially see some big gains later this year.
Fascinating stuff. So just to recap, we started with all this skepticism hanging over the market, right?
Very prevalent.
But then, thanks to this deep dive into Alec Young's research, we've looked at 3 pretty powerful historical studies. We saw how stocks tend to perform after recovering from corrections. Spoiler, usually pretty well.
Surprisingly well, yeah.
We looked at the average lifespan and gains of past bull markets, suggesting ours might not be that old after all.
Right. Still potentially room to run.
And then that kicker, the potential for accelerated performance in the 4th year of a bull market.
That late-stage surge potential.
Yeah. So the overall message seems to be, despite the doubts you hear, these historical patterns, they consistently suggest significant upside could still be ahead, and that momentum factor seems key to driving it.
That's the synthesis, yes. History versus current sentiment with momentum as the engine.
Okay, so that leads us to our final thought for you, the listener, to chew on.
If historical data, like we've discussed today, can offer such a consistent, really compelling counterargument to widely held skepticism, especially in something as complex as the stock market, it makes you wonder, doesn't it? What other assumptions that we hold, maybe outside of finance altogether, what other things that everyone knows might really benefit from their own deeper, data-driven deep dive? Worth thinking about.